Hello, and welcome to our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So let's start with the markets here this week. The S&P 500 gained just over 1% last week and is now up 10% or so for the year. But once again, the more interesting story is potentially underneath the surface. Value stocks are up more than 20% this year. Small caps are up almost 19%, and emerging markets are up 20%. Meanwhile, large cap growth stocks are essentially flat. This has become a much broader market than investors grew accustomed to over the last several years. So markets rallied last week with some pretty impactful economic data and a Fed meeting in the backdrop. The GDP report, that's a great example of a big piece of news that came out and why we don't want to react to a headline number without looking underneath it. So real GDP grew at only a 1.5% annualized rate for the second quarter, and that's fairly soft. But inventories, trade and government spending, those two things were significant drags. Private domestic demand, on the other hand, grew 3.9%, and that's the strongest pace in more than 3 years. So the underlying private economy does look considerably healthier now than those headlines do suggest. Now, the composition of growth is also encouraging. Consumer spending grew 3.2%, while business investment increased more than 8%. We've spent a lot of time talking about AI investment, but we're also beginning to see evidence that capital spending is broadening beyond just high-tech equipment. That's generally not what we would expect to see from an economy that's approaching a recession. Now, the consumer picture is a little more nuanced. Consumer confidence, as measured by the Conference Board here, did weaken again in July, and it does remain relatively depressed. But confidence and behavior aren't necessarily the same thing. Consumer spending just grew at a 3.2% annualized pace, and Michigan consumer sentiment, which has actually been a more negative survey, actually improved in July. So I describe consumers today as cautious rather than weak. They don't necessarily feel great about the environment, but they're still spending. Now, corporate earnings may be the strongest part of this story. With 61% of the S&P 500 reporting, 86% of those companies have beaten earnings estimates and 77% have beaten revenue estimates. Those are very strong beat rates. And blended earnings growth has climbed all the way to 47% versus just 23% expected entering the quarter. Now, there's some unusual items boosting that headline number, so we shouldn't extrapolate 47% growth forever, but the bigger message is clear. Earnings are substantially exceeding expectations, and estimates are moving higher rather than lower. So if growth is holding up and earnings are this good, why aren't we even more aggressive tactically in our strategy? We're actually relatively neutral. And that's because fundamentals are one very important part, but only one part of the equation. Bond yields remain high, US valuations aren't particularly cheap, and our shorter term market indicators have weakened. So, shown here is Ned Davis Research's Fab 5 model, which brings together indicators to score the market on market trend, sentiment, monetary indicators, and composite models that they have in their service. And it shows that the weight of the evidence is at best neutral right now. So we think it makes sense that the market would be volatile here until we get closer to the midterm elections. But a bear market remains less likely without some sort of deterioration in economic growth and the strong earnings backdrop that we've seen. So, to wrap things up, I think there are four things we really want to keep in mind. First, economic growth, it remains intact. The headline GDP number of 1.5% wasn't particularly impressive, but when we look underneath it, the picture is much healthier. Private domestic demand grew almost 4%. Consumer spending was solid, and business investment remains quite strong. And that's simply not an economy that looks like it's rolling over today. Now, second, earnings continue to deliver. This has been an exceptionally strong reporting season, and earnings are growing much faster than what was expected heading into the season. The overwhelming majority of companies are beating estimates, and importantly, estimates are being revised higher. That's a powerful fundamental support for the market. Third, market leadership has broadened. This is something we've been waiting to see for a long time now, and it's been happening in 2026. Large cap growth is essentially flat this year, while value, small caps, and emerging markets are all up about 20%. And that's another reason we continue to emphasize diversification rather than chasing whatever worked best over the last several years. And the final point that we would make is that we should expect a bumpier road from here. Higher bond yields are creating more competition for equities. Valuations leave less room for disappointment. And some of our shorter term trend indicators remain cautious. We're also entering a seasonally more difficult period for markets. So we're balancing two things that the fundamental story remains constructive, but the tactical backdrop has likely become more challenging. Now, we don't think that's a reason to abandon the bull market playbook or make any major portfolio changes. It's more so a reason and a reminder to stay diversified, maintain discipline, and keep our expectations a little bit more muted for the next few months realistically. Strong fundamentals and near-term volatility aren't mutually exclusive. In fact, that's probably the environment we should be prepared for right now. So that's what we have for you this week. And as always, I want to thank you for joining and wish you a great week ahead.